Good evening, ladies and gentlemen. Thank you for joining us for our webinar. My name is Paris Mukuria, and we are just going to begin with a short prayer. And before we go to the introductions, we will say the Lord's Prayer. Our Father in heaven, holy be your name, your kingdom come, your will be done on earth as it is in heaven. Give us today our daily bread. Forgive us our sins as we forgive those who sin against us. Lead us not into temptation, but deliver us from evil. For the kingdom, the power, and the glory are yours now and forever. And Father, even as we begin this webinar, we pray that you may be with us, that you may give us wisdom, and that we may be able to get knowledge and understanding from the lesson that we're going to have. In Jesus' name we pray. Amen. Thank you so much for joining us. Please note that we are also live on Facebook. So you can also share with your friends, share with your colleagues as we interact in this session. Through the session, we're going to be having polls so as to be able to get to know how to better our webinars. And we're also going to be having questions to make it more interactive. I will begin with a brief introduction. I will start by introducing the guest speaker. So today is going to be a really interesting topic, dividends. And I think we have seen a lot of activities happening with the NSC the last couple of years, with a lot of things affecting the stock exchange. So it's going to be a very interesting discussion. We've built up with the webinars from just basic introduction to stock exchange, how to trade, what to look to do our portfolios. So today we will have a very big speaker. We have Eric Jackson. Eric Jackson is the co-founder and CEO of Hisa. Hisa's platform bridges local and global assets, allowing the youth to invest in Kenya and USA stock. He'll give us a bigger introduction when he comes on. Our second speaker is going to be Linda Makatiani. Linda is not new to most of us. For those who've been joining us through, I think this is maybe our 5th or 6th webinar. Linda is a passionate advocate for financial literacy, inspiring and empowering people through investor education. She's a promoter of improving personal financial capabilities in order to create opportunities for individual families and whole communities. I will call upon Linda to continue with the introduction.
Hello, everyone, and thank you, Paris. So I have the honor of introducing Paris. Paris is a seasoned financial expert with an impressive track record spanning 9 years in the dynamic world of capital markets. So currently, she's the driving force behind operations at C&R Group. So we are very honored to have her in this webinar today.
Thank you, Linda, for the introduction. I will now just call upon our guest speaker, Eric, to give us a brief about what Hisa is about. Before we go to what ShareHub does and what is ShareHub in general. So Eric, welcome to introduce your team and to introduce yourself and to introduce Hisa. Karibu sana.
Thanks, Paris. My name is Eric Jackson, as Paris has mentioned. I'm the CEO and co-founder at Hisa. And basically at Hisa, what we do is we allow anyone, but specifically focused on the youth, to invest in both local and global asset classes. So we allow people to invest in Kenyan stocks, US listed stocks, ETFs, and even rates as well. So it's my pleasure and honor to be here today to join fellow shareholders, Hisa users, and anyone else joining in today to discuss about the power of dividends. Looking forward to the session. Back to you, Paris.
Thank you, Eric, for that brief introduction. I'll also call upon Linda to tell us more about ShareHub before now we can dive into the topic for the day. And as I'd mentioned, this is our 6th webinar. We've had a discussion on mastering portfolio management, about rebalancing our stocks, the art of reading financial statements. So by the time we're now coming to the power of dividends, we're now building into our general view of what ShareHub does and educating people on trading in securities and investments. Welcome, Linda.
Thank you very much, Paris, and welcome again to all our attendees. We are very honored to have you join us today on this, what we believe is going to be a very impactful and insightful webinar. So for me, it's just to give a brief introduction on ShareHub. I know for those ones who've been here before or have interacted with us, understand what ShareHub is about. But so in brief, ShareHub is a platform that enables us as investors or us as potential investors to acquire knowledge and to provide that accessibility to the capital markets in Kenya. So the vision for ShareHub is to enable active and empowered investors to maximize their returns in the capital markets. We are on a mission to provide an informative and safe platform to enable everyone to be able to learn about how to trade and also connect potential and existing investors with real market opportunities and enable all of us to be able to fulfill our investment goals. So ShareHub is based on 3 pillars. There's a play pillar, which uses a gaming approach to make it fun and interactive and intuitive as you're gaining your trading skills. And the second pillar is the learn pillar, where you get real-time information and news to support your trading decisions. You know, it's always best when you have an opportunity to make informed investment decisions. And the third pillar is the invest, which is like provides an access to investing in linked securities exchange. And we are working on that one. And once we're able to have it live, we'll be able to share with you. Now, today's webinar is about the power of dividends. And so we want to see how ShareHub equips you when you're starting out your investment journey, and how it can help you gain that knowledge and skills and information that you need to be able to harness the power of dividends throughout your investment journey. So the first way that ShareHub can help you do this is on our learn pillar, and that is through our market info section. This is the section that provides you with over 10 years of data, data on current stock prices, the data on stock price changes, the volumes traded, the stock performance. So in a nutshell, what the market information section on ShareHub gives is access to 10 years of dividend history of listed companies on the Nairobi Securities Exchange. Because ideally, when you're starting out your investment journey and you're trying to figure out maybe part of your strategies, I want to invest in stocks that will be able to provide me dividends. It's always good to try and see what has been the historical trend, and you're able now to do this from the ShareHub platform. And all this is available for the subscribers at very pocket-friendly prices, if I must say. So once you subscribe on the market info section, you start off on a free package where you get access to 6 months trading data for free for 3 months. After that, you're free now to choose. You can either subscribe for 1 year access to trading data for 1,000 shillings, 3 years trading data access for 3,000, 5,000 for 5 years trading data access, or 9,000 for the 10 years trading data. So ideally, this is quite pocket friendly, and it's for the market info section is just providing you with whether you could be a student who's looking, maybe keen on understanding more about the financial markets, how the stock market works, and like delving through the history of the stock market and the listed stocks. You could be someone maybe who's out there doing research, even if you're not already started investing. If you're researching on the stock market, this is a package that could be for you. You could be a beginner investor, a seasoned investor, just trying to maybe gauge and see how your investment decisions could be better. So what market information actually provides is enables you a platform to for you to now go through and make informed investment decisions in a more comfortable space than not being able to have that information. So that's one way that ShareHub can be able to help you to gain access to historical dividend information, to be able now as an investor, figure out how you can harness the power of dividends in your investment journey. Another way that ShareHub can help you is through the play pillar. And the play pillar is, we have a new game that we have recently introduced, and that's the Stock Street. So Stock Street is a game, it's a simulation-based game, but it's based on the actual stocks that make up the NSE 20 share index. So through the game, you're able to get an avenue to familiarize yourself with stocks that are actually listed on the exchange. And through playing, you can either now come in and play as an individual, or bring your friends and compete against each other, or join a league for universities and colleges. And you get to be able to you understand the companies that are there, because most of the companies that we will be discussing in this session, the dividend counters, most of them are actually part of the NSE 20 share index. And because part of the criteria for choosing the NSE 20 share index is the trading activity on the counters, but it's also how stable the companies are, how profitable they are, and their dividend track record. So taking time to play Stock Street gets you now familiarized with these stocks. Another way is it also helps you to build your dream portfolio. Because if you're an investor and you've thought about what would I do if I had like 1 million shillings to invest, and maybe in real you don't have that 1 million to invest, but Stock Street now provides a safe environment for you to be able to do that. So for like 1,000 shillings, you're able to get you can be able to build a portfolio of 1 million, and play around with the stocks that are listed on the that form part of the NSE 20 share index. And now you're able to try and see, if you were to invest in this company, how it would be. So ideally, it's good for the Stock Street would be good for someone who's looking to learn how to invest, or a seasoned investor, and you're keen on figuring out the kind of portfolio you'd be able to build to maximize on dividends for you. So ShareHub is ideally set to grow you as an investor, whichever stage of the investment journey you're on. So if you're just looking for research, you're able to get it from our market info section. If you're looking to understand more about investing, the real stock market investing, you would start off maybe by downloading the app. Then you subscribe. From subscription, you have an option of starting out, understanding more on the theory, starting out on the Jikuze quizzes. Then you'd play the Wazito game, which is a virtual simulated game with virtual companies. And then from there, progress on to Stock Street, where now you get yourself familiarized with stocks that are actually listed on the exchange. So as you move on to the next step of actually now starting to invest in the real stock market, there's some level of skills that you have gained, confidence as well. And you're we've been able to provide this in a low risk environment, because a virtual environment gives you a safe space for you to be able to try out what you have read or what you have seen, and you're able now to, to get that into practice more confidently now when you're putting your real money out there to start investing. So thank you, Paris. I think that is in a nutshell how ShareHub is able to help you, and to, one, start off your new investment journey or continue, make your investment journey better, and more so to be able to harness the power of dividends when it comes to in your investment journey.
Thank you, Linda. That is wealth of knowledge that you have, and thank you for sharing that bit with all of us. As we're diving deeper into dividends, just pointing out that dividends are not just payout for companies, it's also a way for us to invest, especially if it's someone is getting into long-term investments. So, and this webinar is an opportunity for you to understand, to get deeper understanding of how dividends can work for you as you embark in your journey to financial empowerment. The takeaways that we would want to have maybe from this webinar would be the importance and impact of dividends, the tips on how to invest in the dividend stock, understanding an understanding of how ShareHub, the virtual game works, the Wazito and the stock street support. I would urge, if you've not registered for it, please do go to the app and just look at it. There's a lot of corporate action that is there. There's a lot of share price, just seeing the share price trends for the for various companies that are listed in the stock exchange for the last 10 years, because we have access to that. We've been able to collect all of that and just get to see how the market is playing and how the market is doing. And we'll also get to know more about what Hisa does and how Hisa can come in our financial journey. So I'm going to invite our guest speaker. The Q&A section, please post on the chat in the middle of the presentation. We'll be taking breaks and taking questions, the questions that are on the chat. And at the end, we'll take the lump sum of questions and also go into the live questions. So now I would like to take this opportunity to welcome the CEO for Hisa, Eric. And I think his bio did not say so much about himself, and I want him to do that because he's a decorated person. I don't know why he's playing modesty. Please. So Eric,
yeah. Thanks again, Paris. So maybe again, just to take it back to the intro, as I initially mentioned, Eric Jackson is my name. I'm a co-founder at Hisa, and basically with Hisa, the big dream is to allow anyone to invest in the easiest way possible. So one of the biggest challenges, or one of the challenges that I faced myself when I started investing, or when I wanted to start investing, was that there was a lack of access. Just if you want to invest in the stock market, I think a few years back, you'd have to visit a stockbroker, you'd have to fill in some forms, and then you'd have to wait for a number of days or maybe weeks for an account to be opened. And it was basically a manual process, which took quite a lot of time. So Hisa was actually born out of that frustration to basically address that challenge, to help people and allow them to easily, from the comfort of their devices or of their phone, to easily start their investment journey. Yeah, so myself, maybe just a quick background or context about myself. Actually a trained electrical engineer, but I did not practice engineering at all. So after campus, I joined Kenya Airways. So had my first job at Kenya Airways, which was basically in the software development team. So using big data and machine learning to be able to help the company make better business decisions. And I think that was when I got introduced to AI and stuff like that. I know AI is a big thing now. But I think I got my first sort of like interactions way back when I was working at KQ. So then after that, I left to start my first company, which was a mobile advertising company called Nano Digital, together with a friend of mine called Maurice. So did that, and basically what we did or what we do is send out SMS and MMS adverts from be it banks, telcos to their end users. And then that eventually grew into MediaPal, which is again an advertising company that then works with different platforms like Google, Twitter, and social media to basically advertise to both brands and agencies. So before I basically started Hisa, I would say I didn't have much knowledge about investing, so to speak. But then when we started looking at the problem and looking at how can I invest, I really saw there was a big challenge that sort of had to be addressed, and I think that's how we started Hisa, to basically address this challenge. So I think enough about me. I think you guys are here to listen to the presentation about the power of dividends and of course understand it and also apply it in your investment journey. So I'd like to do what I always do before the beginning of any presentation or any meeting, is basically to ask the audience to basically share with me their expectations from this session. So, when you saw the advert about this specific webinar on the power of dividends, what is the expectation that you had in terms of what the delivery of or what this presentation will have? So you can just type in the chat your expectations, and then at the end of the session, we'll try and see if we have met your expectations. And again, feel free to share feedback or stop me anytime to sort of like ask questions or go through anything that's not clear. So I think, Linda, maybe if you could just present the presentation, then we can run through it.
So as Linda is projecting the presentation, maybe I'll just take it to mention that if you've missed our previous webinars, we have it on our YouTube channel and the Share Hub. We had demystifying introduction. Our first one was introduction to stock market, where we demystified its complexities. Our second one was diving deep into the art of reading financial statements. Our third one was mastering portfolio management. And the last one that we had, I think a month or so, 2 months ago, will be rebalancing your stock portfolio and how to build a solid foundation on that. So we have had, I think we've had Abogini coming in, we've had various companies coming in, and we are grateful for the wealth that we've been able to amass. Also, I'd like to thank maybe the team that is behind all this. On our end, we have Linda Makatiani, who is also one of our speakers. We have Irene Mugwa, who is also in charge of Share Hub, and we have Nelly Njeru. So for those that you'll be, for the interactions you'll be having on the chat, those are the people you'll be interacting with, and just we thank them for constantly organizing this. So I'll take us back to Eric. The presentation is up.
Thanks, Paris. So again, just a reminder, please share your expectations in the chat, and then we can be able to see if we meet your expectations or exceed them. Yeah, so just a quick intro about Hisa. So we are an app, so we are available both on Play Store and App Store. So if you want to check us out, you can sign up for Hisa and see how we work. We also have a web app, which you can access via web. Our website is www.hisa.co, so you can go there and check us out. We first got the CMA approval to launch US stocks trading in November of 2021. And since then, we've just signed up about 20,000 users using our app. And of course, we work with different regulated players. So both FIDA Investment Bank to offer the stocks to end users. So these are just some of our partners. And again, I know ShareHub, we are working on a partnership. So soon we'll have ShareHub here as well. But basically we work with both the NSE, CDS, CMA as our regulator, NABO Capital and FIDA Investment Bank, which I mentioned earlier, and also Ingot Brokers. So the products that you can access on Hisa, as I mentioned, is basically your everyday Kenyan companies. So we have 63 listed companies on the NSE. So you can be able to access and invest in all of those. And then besides that, we also give you access to over 6,000 US stocks. So especially for the youth, you probably use an Apple product. If it's iPhone, you use Google search every day to look up things. Maybe you have a Microsoft, you use Microsoft Office for some of your things. You know about Tesla, you know about all of these companies. So it's very, very important for you to stay in touch with and invest in some of those companies so that you're not just a consumer anymore. You are actually a participant and a shareholder in some of these companies. Even the football fans, Manchester United is actually listed. So if you're a football fan, you can actually be able to buy Manchester United shares on Hisa as well. And then besides that, we have ETFs, which is basically exchange traded funds. And what these are is a basket of stocks. So rather than investing in single stocks, you can actually group those stocks into a basket and invest in that one basket. And then you get access to all of those individual stocks. So we have all these ETFs from the major providers like Vanguard, BlackRock. But again, we'll have another session where we can go through that. Or if you're interested to learn more about this, you can reach out to us at Hisa and we can basically take you through that. And of course, CDS. So before you start investing, you hear a lot about CDS accounts and stuff like that. So on Hisa, what we do is we allow you to actually create or connect your CDS accounts, which is a requirement before you start investing on the Nairobi Securities Exchange. But once you've connected or you've set up a CDS account, we can allow you to actually do much more with that account. So you can actually be able to gift or transfer the shares or even use those shares as collateral for loans. So all of these things, are features that you can be able to access on the Hisa app. So to start us off on the power of dividends, I think the best way to look at dividends is, just going a step back and asking yourself, why do you start investing, or why did you start investing? And I think the answer to most users or most investors is you are investing for returns or for gains. And if you're investing for gains, then in the stock market, there's two key ways in which you can earn gains from your investment. So the first one is through capital gains, whereby you invest a certain amount today, and then that amount after a month or two is, if the stock goes up, then you actually have gained. So your capital has gained. So that's why it's called capital gains. But the other second way in which you can earn from the stock market is through dividends. And basically dividends, what they are is a distribution or a portion of a company's profits that is basically distributed to its shareholders. Usually in Kenya, it's at the end of the year. So what happens is at the end of the year, the companies sit down, declare the dividend, they declare their profits, And then out of that, they're able to say, you know what, this year, since we had a good year, we are going to then pay back to our shareholders X amount as dividends. So again, in simple terms, dividends is just a portion of the company profits that is distributed to shareholders at different intervals. So for Kenya, it's usually mostly annually, but for the US market, we have companies that actually pay dividends on a quarterly basis, and some that even pay dividends on a monthly basis. So the first thing that then you can think about as dividends, or that I like to think about as dividends, or as the biggest reason why you should look at dividend stocks for that matter, is the fact that for dividends, you're basically earning passive income. Again, we go back to the earlier point I made about you investing as an investor in the stock market. You're basically looking for gains. So, and again, you're looking for the gains in two ways: either capital gains, where the stock price goes up, or you're looking for gains where you're getting dividends as a source of passive income. So, and if you look at other ways of earning passive income, is maybe if you have a business, so you have set up a shop, and you have someone running it, so that can be a source of passive income. Or if you've invested in a money market fund, that's also another source of passive income, whereby you've invested in, let's say, a money market fund. For us, we're working with Nabo Capital, so I can use Nabo Capital as an example. And basically, at the end of the year, they pay you interest on how much you've invested. Or another way of earning passive income is through bonds with the government. So you've invested, you've bought a bond, and then the government is basically paying you interest for the money that you've invested. But dividends are actually also a very good source of passive income, because most dividend stocks, and we'll get to this later on in the presentation, most stocks or most companies declare a dividend based on what is called a dividend yield and the company share price. And then you're able to actually earn. So if you look at, if you compare dividends onto the other forms of passive income, it's actually also a very good way for you to earn. And the best part is that you don't have to do anything. You don't have to trade every day. You don't have to, keep looking at the stock price every single day to decide if you're supposed to buy more or sell more. As long as you're a shareholder, as long as you own those stocks, then if it's an annual payment, then at the end of the year, you will get your check or your mobile money payment or a bank transfer of the amount of dividends you've earned. So again, dividends, I think the first thing is just looking at it as a source of passive income, so that then you can stack it against the other sources of passive income that you have. So be it your bonds, be it your money market funds, or be it, let's say, a business that you've set up and you have someone else running it. So it's always good for you to look as an investor, to look at all the different investments you have vis-a-vis the other available investments, so that if you see, you're earning your dividends from Safaricom, maybe let's say the dividend yield is 10% every year, rather than putting in a business that would give you back 10% but needs a lot of your time to work on it, then you can just look at getting enough dividend stocks that you just invest in, and you're able to still make the same amount. Because I believe as an investor, it's your first duty is looking at the best investments that will give you returns. But then the next one is how much effort are you putting into the investment. So you can have an investment that is very lucrative, but you have to spend your whole day researching, or you have to spend your whole day looking at the stocks or the prices and everything for you to get the gain. So again, it's always a balance between what's the return versus the risk, of course, but also versus the amount of effort or amount of time you put into the investment. And then the other thing, the second one is the compounding effect of dividends. So I think I think I've forgotten who said this, but they say compounding is the eighth wonder of the world. Just because the way we are wired as humans is we are not able to quite comprehend or quite calculate quickly compound interest. But as an investor, once you start investing and you see how compounding works, you definitely are hooked on. So let's say, for instance, if I ask, just the audience again, if I give you 100 shillings today, and you're compounding at, let's say, 10% annually, how much is that in 5 or 10 years? So if it's simple interest, that's easy to calculate. But if it's compounding, it's not easy for you to calculate that off the top of your head easily. But once you calculate that, you actually realize that you end up with a lot of money. So I'll give you this example just to, again, illustrate the point that we are making. So let's say you have acquired 100 shares of a dividend-paying stock from a Kenyan company. And again, we'll get to the list of all the dividend-paying stocks on the NSE at, let's say, for instance, 50 shillings. So, and the dividend yield of this company is 4%, meaning at the end of the year, you earn 20 shillings per share. So which means you'll be able to receive at the end of, sorry, I think I have an issue with my calculation here. They should actually be 2 shillings. So I'll just correct it and we can go through as we go. So you've acquired 100 shares of, let's say, for instance, Stanchart, or let's just say company X, and you bought that as 50 shillings per share. And the company distributes an annual dividend of 2 shillings per share, resulting in a 4% dividend yield. So meaning at the end of the year, you'll receive 200 shillings in dividends. Yeah. So here on the right is a graph, just to help you visualize, is a graph of, it's a graph of the blue line is you've invested in a company over a duration of time, starting from 1 year to, let's say, 31 years. And if you don't reinvest the dividends, if you started off with 1,000 shillings, at the end of 31 years, you'll have about 2,000 shillings. If we're just assuming, let's say, modest gains, capital gains for that stock. So this is whereby, you've invested 1,000 shillings at the start of this year, and you just put it in a stock. Maybe it's gaining 2 or 3% every year. At the end of 31 years, you won't have much. You'll have just made 100% gain, which is not bad. But over 31 years, I think that's, if you annualize that, that's still quite low. Yeah. Then the red line is whereby you've reinvested your dividends. Yeah, but then the company dividend doesn't grow. So let's say, for instance, the company pays a constant dividend every year. Yeah. So here you have start off with 1,000 again. After 31 years, you can see that that's almost 4,500. So if you compare to the person who did not reinvest their dividends, so who means every year they received the money and they used it and didn't reinvest back, that means that you're better off than them by almost 2,500. So you've doubled the money that they actually receive. And then the third chart, which is the green chart. Sorry, just go back, please. So the third chart, which is the green chart, is whereby you reinvest the dividends. And then we are assuming a 4% growth in dividends, in the dividends that are being distributed by the company. But also now here is where you get to see compounding really work, because you receive your dividends every year, you reinvest them back in the company, but also then the company at the end of the year also grows their dividend yield slightly, let's say by 4%. So you see that for this chart, you end up with about 9,000, I think it's about 8,900, which is 6,000 more than the person who did not invest their dividends, and almost double the person who reinvested their dividends, but there was no dividend growth. So this just shows you that, if a company is paying dividends, and we're assuming that yield is going to grow every year, and you as an investor decide that, you know what, for all my investments in Safaricom, I'm not going to actually take out the dividends. I'm going to reinvest them back in the company. At the end of a period of time, a long period of time, you actually are able to triple or double. Let's just get the actual. So 2,000 over 9,000. That's actually almost 4.2 times more than the person who didn't invest their dividends. So this is one of the things that, you as an investor should actually look at, and which is some saying the first rule of dividends, which is always reinvest your dividends, because at the end of that time, the money you'll have earned from the dividends will be quite high compared to the capital that you will have put in. And then the other thing that personally for me, I look at dividend stocks quite keenly is the stability they give you during volatile markets. So as an investor, obviously, when you start investing, and this is something that we do, and I'm sure ShareHub does, is we always tell you that all investments carry risk. And for the stock market, again, it's considered more risky than, let's say, for instance, bonds or money market funds, which means that at any given day or month or week, the share prices fluctuate. So you have cases where the share price will go up, and then sometimes that share price will go down. So it's important then for you as an investor to look at dividends as some sort of stability during such volatile markets, because at the end of the day, and I'll give you again an example of, let's say, companies that pay dividends locally, be it your Stanchart or Safaricom or ABSA or KCB or Equity Bank. Most cases, companies will still distribute dividends yearly, meaning for you as an investor, regardless of how the markets are performing or regardless of the share price, you will actually still be able to receive the dividends, meaning that, your stock might actually be down, but at the end of the year, you will still get your dividends, which is some sort of gain, rather than the capital gain, which again, when the markets are not doing well, the stocks will be down. So this helps you maintain your confidence, which is very, very key, because the worst thing that can happen is you getting into a stock today, and then the next day the stock is down 10 or so percent, and you get jittery feet, and then you take out all your investments and you say you would never invest in the stock market again, which I'm sure is the case that has happened to some people. So it's always good to look at dividend stocks or dividends as a way to insulate or provide some soft landing, especially when the markets are being very, very volatile. Yeah, so I think at this point we'll like to take a break to just look at the polls, the questions. I can see there's been a lot of activity, so I'll just hand it over back to Paris, so we can discuss a few things before we proceed to the next points.
Well, thank you, Eric. We have so many questions that have come in, so we'll try and group them so that we can maybe address them at once. The first group of questions will be, or maybe we'll just start more on what the topic is about today on dividends. Then we will go to a bit of what questions that have been directed to Hisa. So the first question is from Justin. Justin has asked, how much is enough to invest in the stock market that can enable someone to have his money work for him and never have to work again? Hey, Justin, if you get that secret, I also want it. The second question is from Justin again. What are some of the factors that lead to decline of prices, and why are most common companies underpriced as per the book value? The third question is, what is the best criteria to use when you want to reinvest dividends? And the fourth question under this category is, what is minimum investment capital in ShareHub? So that one, the last question about minimum investment capital will be addressed by Linda. I'll request you to address the first three questions. I can repeat the questions again. How much is enough to invest in the stock market that can enable someone to have his money work for him and never have to work again? What are some of the factors that lead to decline of prices, and why are most common companies underpriced as per the book value? And the third one, what is the best criteria to use when you want to reinvest dividends? Those are your questions, Eric.
Thank you. I think, Justin, if we all knew how much it is enough to to all make money work for us, I think we'd all have that as our North Star to basically guide our investments or our income. But I think what I can say is that personal finance and investing is actually very personal because it varies from person to person. So one key way for you or that you can look at this is to look at sort of like your expenses and your income sources, and put those together or put those side by side against each other, and then you can look at let's say, for instance, if you're planning to retire, I don't know if you have a job or if you're planning to retire in X years, and basically then work backwards. So how much do you need to have, or how much do you use every month, or how much will you require to use every month for this number of years without needing to work anymore, without needing to get any new forms or sources of income. I think that would be the first way to consider that question. And once you have your number of years, or once you have the monthly spend, or the amount that you need every month to spend without needing to work or do a job anymore, then that would be your magic number. Then, of course, you'd look at what are your current sources of income, but also then what are your other investments, because the stock market is just one part of your investments. So as we mentioned earlier, you have the bonds. Lots of people have invested in real estate, but other people as well invest in alternative asset classes, which include digital assets, let's say, for instance, crypto, or investing in businesses. People invest in startups and stuff like that. So you look at all of those investments and how much they're bringing, how much income they're bringing to you at the end of the month or at the end of the year. And then once you have those, then you can then look at, let's say, if we are looking specifically for dividend stocks, and you're looking for, I don't know, 10,000 Kenya shillings per month from dividend stocks, then you can then look at which companies then have been consistent in paying dividends, and what is their dividend yield. So from that, then you can actually find out, this company pays this much dividend every year. So if I invest $1 million, let's say, for instance, in KCB, then at the end of the year, I'm going to get 100,000 in, I'm just using, again, hypotheticals here, 100,000 in dividends. So then that's going to then be your answer of how much should you invest in KCB, for instance, as a stock specifically, to be able to be set for life to never work again. So I think there's quite a number of things to look at, but I think the best way would be, again, just for specific case for Justin, is just reach out to the ShareHub team, or the Hisa team, we can be able to actually then, have a one-on-one conversation and elaborate more on what you need to consider, what you need to have to be able to then guide you towards working that number out for yourself. And then the second question was about factors that lead to decline of prices. So the stock market is also, I think one of the things that affects the stock market prices is emotion and general external factors that actually beyond the company. So let's say, for instance, you're a company based in Kenya, you have, you're earning very good profits, but then at the end of the day, there is, let's say, for instance, stability, security-wise or political. Those are things that are out of your control, but they still affect investor sentiment, because at the end of the day, it's people that are investing in those companies. At the end of the day, the stock price is just based on the demand and the supply. So if the price of Safaricom today, if it opens at 15 bob, I think today it closed at about 15.75. If it opens at 15.75 tomorrow morning, and then everyone who holds Safaricom shares says they are selling them only at 20 shillings, then it means that you who wants to buy Safaricom shares, you either have to wait until the stock price gets to 15.75, or you just have to pay the 20 shillings. Then if you pay the 20 shillings, then that's the new, Safaricom share price. And again, so those things are usually mostly sometimes out of the company's control, because there's also external forces that are affecting investor sentiments, or maybe something bad happens and a specific stock price or a company, there's some changes in management, or there's some cases that affect people negatively or bring up negative sentiment from users, then again, you're going to see the stock price behave quite differently. And that's why I think your second is mostly an observation where you're saying most common companies, they are underpriced as per the book value. So again, there's a lot of external forces that are affecting the stock price, even though it's fundamentally a good company. So I think I'll let Linda address the third question, and then I can take the last one.
Thank you, Eric. I think just to add on as well, sometimes, and I think we say this at Shahab, sometimes it's good to, when you start figuring out how much you need to have for you to be able to live off your dividends, it could be such a sum that it can actually scare you from actually starting. So ideally, what Eric said, you try and work it backwards so that you see what can I start with now, and then your mindset is that you end up building up on it, so that maybe if you're planning on now living off your dividends, maybe 10 or 15 years, you're able to do that then. But if you think of it as a lump sum now, so that you're able to do that then, it might be a bit scary. So it's always good, break it down. I think it's Justin who asked you, break it down and then see what are you comfortable starting with now. And then as time goes, you also grow your investment, and then the power of compounding as well, reinvesting your dividends and everything, and you'll get yourself to that. On ShareHub, once you download the ShareHub app, you're able to access the Jikuze quizzes, which is free. That is more on the theory bit, where you get to understand more of the theory bit when it comes to investing. When you start on the games, it's 100 shillings, but for every 100 shillings that you invest in the game, you get 10,000 virtual money. So now you're able to, you can use the 10,000 to be able now to start buying stocks, the virtual companies that are there for Wazito. And as well, it doesn't just have to be 100. When you get capacity, you can put, for 200, you get 20,000 virtual money. For 300, you get 30,000 virtual money. So you're giving yourself leeway to be able to try and figure out how to grow your portfolio with dependent on how much you're investing. So the minimum is 100, which gives you 10,000 virtual money. But the limits is up to you, dependent on what skills you want to learn, or what counters you want to invest in, whether it's on Wazito or on Stock Street.
Thank you. I think maybe Pace, if you could just remind me the fourth question.
We had, what is the best criteria to use when you want to reinvest dividends?
Okay, when you want to invest in specifically dividend stocks or just any stock?
The question was just when you want to reinvest dividends. So maybe you can cover both.
Okay. Yeah, so I think again, like, and I'm sure, we can organize another webinar to go deeper into now, just the different themes or sort of like how to look at stocks or what specific things to look for when you're investing. But I think how to look at it is there are different investment, I'd say, categories or ways. So for dividend investing, you're just looking at the dividend that the company is paying. So the key things to look at that is, of course, the dividend history. So how long has this company been paying dividends? So there's companies in Kenya that have been consistently paying dividends over the last, I'd say, 10 to 15 years. And then after that, the next thing you look at is the dividend yield. So what we mean by the dividend yield is how much dividend or how much is the company paying in dividend per share. So meaning if you own, I think if you own a share of, I think Umeme, the dividend yield is maybe about between 13 or 14%, depending on the share price. So meaning for every one share of Umeme you get, if the price is, let me just use a random example. If a stock price is at 100 shillings and the dividend yield is 10%, it means if you own one share, then you're going to get 10 shillings for every share you own. So again, the dividend yield is very, very important to look at when you're comparing dividend stocks specifically. But then there's different other ways to invest. So of course there's value investing, which is what Warren Buffett has really made popular. He's a value investor. So for him, he's basically looking at companies that have specific values and have specific advantages in their industry. So he, of course, invests in companies like Coca-Cola and companies like Apple. So if you come back to our case on the NSE, if you're a value investor, then you're looking at companies, let's say, for instance, Safaricom that has a lead in the telecommunication space, or in the banking sector, you're looking at maybe your equities and your KCBs as well. And then there is growth investing. So growth investing is you're just looking for companies that are growing. And that usually changes over period of time, maybe yearly, 3, 4, 5 years. And for that, if you're looking in the case of Kenya, is you're looking at what specific sectors in that country or in that stock market are growing, and then you're basically investing in those companies. So again, I'd say there's different ways to look at it, and we can do a proper session where we just go through all the specific ways to look at stocks or to invest. But I think just to, if you're looking specifically for dividend stocks, I'd say you start with the dividend history. So how long has the company been paying dividends? And then what's the dividend yield over that period of time? So you might want to invest in a company with 1% dividend yield, but that means you're getting less per share than that someone who's investing in a company with 14 or 15% dividend yield.
Thank you for the comprehensive response. We'll go back to the presentation as we continue receiving the questions. And thank you all for the engagement. We have so many questions that we received today. I don't know how we're going to answer them, but we will make sure that we at least address each and every one of the questions. Back to you, Eric.
Thank you. So just going back to the presentation, and again, keep the questions coming. I can see there's quite a lot of interest just around the process of dividends. And yes, as an investor, I think this is one of the topics that is not, talked about enough, but it's actually very, very important because besides the capital gain, dividends really offer you a great way or a great source of income. Yes, so just going to the next slide. So So the fourth thing that I personally look at, and maybe you should as well, is basically diversification and to some extent mitigating risk. So diversification meaning when you start investing, I'm sure everyone has had or has been told about not putting all your eggs in one basket. I think that statement is very profound, and you shouldn't take it as lightly as it sounds. Basically, because companies or sectors might perform badly over a period of time. So let's say, for instance, you might have a company that might perform badly this year, or you might have a specific sector that might perform well, but also there are those that perform bad. So if you look at maybe again an example for this year, we are seeing a lot of technology companies performing really, really well. So especially around artificial intelligence, I'm sure everyone has heard about ChatGPT. So there is a lot of companies that are performing very well based off of just the fact that AI is being touted as going to change a lot of things in our country. And if you've looked at what ChatGPT can do, I think you can agree to some extent that even though there's fears and everyone says AI is going to take all jobs, you can see that actually artificial intelligence has really changed or impacted lives just through the interactions with things like ChatGPT and Google's Bard. So it's very important then for you as an investor to not invest or not to have all your investments in, first of all, one asset class. What I mean by asset class is you shouldn't have all your investment in the stock market, or all your investments in bonds, or all your investments in real estate, or all your investments in crypto, or all your investments in whatever you're buying. You should try and diversify those investments in different asset classes so that you have some stocks. And again, for stocks, you can have Kenyan stocks, you can have US stocks, you can have, you can have maybe stocks from other African stock exchanges. And then for the bonds, again, for the bonds, we have different bonds. So you have infrastructure bonds, then you have the treasury bonds and bills that are issued every often by the CBK. And then you have the unit trusts, where you have money market fund, you have equity funds, you have balanced funds. So again, different. So it's good for you to have or diversify your portfolio so you have different aspects or different asset classes in there. And then now, when you go now deeper into, let's say, for instance, stocks, again, for stocks, you want to invest in first different sectors just to reduce your risk or to mitigate your risk, so that if tech is not performing well, or if banking is not performing well, or if consumer companies are not performing well, then the other sectors are also not going to be affected as badly. So it's good to always balance. So you can have some tech, you can have some medical. So let's say for the case of Kenya, you have the banking, you have investment services, you have insurance, you have telecommunications. So all of those different sectors, you have to look at some of them, not all of them. You have to look at those sectors and decide, what, I'm not going to invest all my investments in one sector, because then if that sector doesn't do well, you as an investor, you're going to be affected. And then after that, then when you come out, so you've said you're investing in telecommunications as a sector. So then you also now look at, what dividend stocks are under telecommunication or banking. So again, for the case of banking, which has the most stocks, so we have your equity, your KCB, your NCBA, your ABSA, your I&M, all of those listed on the NSE under banking. So you then look at, okay, so why should I invest in equity over KCB? And again, I've had, I think from Paris, there was a previous webinar of analyzing financials to be able to make a decision to invest. So you can analyze financials, and then you can also look at management, but then you can also now look at things like dividends. So looking at how does KCB versus Stanchart versus ABSA versus equity compare in regards of the dividends they pay. So that can be one of the ways you look at it, so that then when you're diversifying your portfolio and when you're trying to mitigate risk as much as possible, then you look at all those considerations to then have some dividend stocks in your portfolio. So again, just to sort of recap that, the importance of not putting all your eggs in one basket so that you're able to have different asset classes in your portfolio. And then besides asset classes, then when you look at different sectors as well, so that then you also spread your risk over sectors or industries. And then now eventually now when you come back to specific sectors, also now looking at companies and looking at how you value the companies, the management, the historical dividends and the dividend yields, just to help you make a decision about then what stocks you're going to invest in. Next slide. So yes, so I think this is what I've been trying to refer to. So these are some of the companies in Kenya that pay dividends and have been, we'll mention those that have been consistent over the past years. So Williamson Tea, Kenya, which is an agricultural company. The current price is about 265 and the dividend yield is 11. So meaning that for, if you have, and Linda had mentioned this, for you to invest in Williamson Tea, you need to invest you need to buy 100 shares of that. So I think that would be about 26,500 as per 15th July, the price. So, you buy 100 shares of Williamson Tea at 25,500. Then at the end of the year, you're going to get an 11% dividend yield on your shares. So maybe if you, per share of Williamson Tea that you own, you're going to be paid, let's see, 11.5 of 265. Let's just see how much that comes to. That's about 24 shillings. So for every share of Williamson Tea that you own, you're going to be paid 24 shillings. So for 100 shares, then it means at the end of the year, you have 2,400, as your dividend. And just to address maybe a question that was asked earlier. So if you can take out your dividends and use them. So the way dividends work is when a company declares a dividend, they're actually paid out. Unlike capital gains, so you see capital gains is if you buy 100 shares of Safaricom today, and tomorrow it's at, if you buy today at 15 bob and tomorrow it's at 20 bob, until you sell Safaricom, you can't be able to get, the capital gains. So it will just be unrealized gains, meaning you own Safaricom, you bought it at 15 and it's now at 20. So your capital has gained by 5 bob. But you only realize that gain when you sell the Safaricom to someone else. But for dividends, it's basically you're paid for holding the shares. So let's say you bought Safaricom last year at 15 bob. At the end of the year, they declare the dividends and pay a yield. So meaning, you still have your investment in Safaricom intact, but then you're paid the dividends separately. So you can then decide to reinvest back that dividend by buying more Safaricom shares. So again, just to clarify that, the dividend is paid out. It doesn't stay in as capital gains. It's paid out if it's every year. Every year you'll receive a check or a mobile money payment of the amount of dividends you've earned. So you as an investor can then decide to reinvest it back into the company. And then, so again, just looking at the yield. So this is why the yield is important. Because everyone is investing to grow their money or to get returns on their money. And again, just to go back to where we started, there's different asset classes you can invest in, but it's your job as an investor to then look at what is this asset giving me in return, which is the return on investment, the ROI, as most people say it. How much am I earning from this investment? And then why should I keep investing in it? So I'll give you an example right now. So I'm sure very many people are familiar with money market funds. And most money market funds, I think they would pay you an interest per year of maybe between 9 and 11%. So meaning, if you invest 100,000 at the end of the year, assuming 10% gain, you'd get 10,000 extra. So, but then as you can see from this table, we have Umeme, which is a listed company. The dividend yield is about 15%. So meaning an investor who invested in Umeme, actually at the end of the year, they'll get more money from an investor who put their money in a money market fund, because the money market fund will pay you an interest of maybe, let's say 10 or 11%. But Umeme on its own, from the dividend, just the dividend alone, you're going to get about 15%. That's at the price that it was on Tuesday, I believe, on Tuesday 15th. So again, let me just take it again from the top to just show you the power of dividends, or why I mentioned that dividends really should be taken more seriously, considering the case of Umeme. So at the start of the year, the price of Umeme was about 7 shillings and 42 cents. So if you bought 10,000 shares of Umeme, you'd have spent about 74,200. Yeah. And then since the year started, Umeme the price has really risen quite a lot. And now the price is about 14.3 thereabouts, which means now your same investment, which was 74,000, today would be about 143,000. So again, just to reiterate, for the capital gains, you only get them when you sell. So in as much as you would have your Safaricom, your Umeme shares, which you bought at 74,200, today, if you log into your portfolio, that value would be about 143,000. But you would only get those gains if you decide to sell it and get the cash back. So that would be a 92.7% return on investment, which is quite high. So, but then additionally, Umeme also pays an annual dividend. So this year, on 27th June is when they closed their books, and the price was about 13 shillings and 10 cents. And they paid out, the dividend yield was 18%, which is really, really high. So meaning, if just using the same example, for any investor who had bought Umeme at the beginning of the year, worth 74,000, they would additionally receive 24,000 as dividends. So if you calculate all of these, just from hypothetically from that investor, they still have their capital gains, which is about 68,000 from the gain, but they already received the 24,000 dividends on July 20th. So again, then we go back to the fact about reinvesting the dividends. So if this person then decided to put back the 24,000 Kenya shillings when they received them, then it means, just from Umeme itself, the start of the year you put in 74,000. On July 20th, you got your 24,000 dividend, but you put it back. Now your investment is about 98,000, without even looking at the capital gains. So that's why I say, it's very important for investors to really look at dividend stocks, because they offer a way for you to earn very passive income without you doing anything, for you just holding the shares of that company, over time. And then if we look at Stanchart, which is the next case study. So again, for Stanchart, they're also one of the consistent dividend paying stocks on the Kenyan stock market. The price is quite high, it's about 142 shillings. So for an investor who at the start of the year maybe invested in 1,000 stocks of Stanchart, or was already holding Stanchart stocks at 142,000, right now, Stanchart has been up about 14% since the year started, which is not very high, but it's still good, or better than, let's say, for instance, a money market fund or something else. And then additionally, Stanchart also pays an annual dividend. And this year, the dividend yield was about 9.8%. So meaning, besides the capital gains of 14%, you're also getting a 9% 9.8, sorry, percent dividend every year. So again, if you look at the maths just from Stanchart itself, you from the 142K, you already would have made ideally about 36K in both capital gains and dividends. So this is why it's very important when you're investing as an investor to always look at that element of dividends. And again, we can look at a reverse case where the stock price goes down. So let's say, for instance, if we reverse the Stanchart example, whereby the stock price was at, let's say, hypothetically, it was at 163.25 at the start of the year, and then it has declined 14%. So it's now at 142.7. Since Stanchart pays a dividend, regardless of that stock movement, they would still pay the same dividend to you as an investor for holding, for being a shareholder of Stanchart. So meaning you'd still have received your dividends of 15K, but then your stock is now down about 20K. So meaning you as an investor, if let's say, for instance, you want to exit today, you're not going a loss of 20,000. You're only going to, from your investment, even though the stock price is down about 14%, you're only going to go, only going to lose about 5K, because then the dividends, you already received dividends, which have then sort of acted as a buffer from the loss that you would have received if the stock price went down. So those are the things that we look at, or that we ask investors to look at specifically when they're looking at stocks and dividends. We understand that the stock market is volatile, that prices can go up and they can go low, but also looking at dividend stocks, or looking at stocks that can then provide you some sort of income in between all those movements of the stock price is very, very important. So I think before I finish, we can just go back to the dividend yield again, so we can just elaborate or discuss it further. So, and I'm sure there's going to be questions around this. So when we talked about dividends, we said, and I'm happy that we also ran a poll about how important it is for you to look at the dividend history when you're considering investing in dividend stocks. So the very first thing you look at, of course, is the history. So how has this company been paying their dividends, and how consistently over its history? So as I mentioned, in the Kenyan stock market, we have a few companies that have been very consistent. I think Williams-Onti is one of them, Stanchart as well, BAT. Those are very consistent dividend stock payers. And then after that, then you look at the yield. So the yield is basically for every share of a stock that I own, how much dividend am I going to receive? And the yield is basically as compared to the stock price. So for if we look at BAT, I think there's a question from Peter asking if BAT is the one that has the highest dividend yield. At the moment, no. At the moment, the highest dividend yield is from Umeme, because again, the yield is in comparison to the price. So if you have the BAT price is about $429, 429 Kenyan shillings. So meaning 13% of that. So they're paying about 50 shillings on dividends per share. So you should always look at what's the yield that this company is paying in dividends, but also then how consistent has this company been in paying dividends over its history. Then that helps you to then look at, or to narrow down into, okay, these are the companies, or these are the stocks that I should consider to look at when I want to invest in dividend stocks. So I think I have come to the end of the presentation. I think we can go back to Paris to just go through some more questions and some more discussions. Before we wrap it up.
Thank you, Eric. We have a lot of questions that have come in. We'll go direct to some of them. The first question is from Yvonne. What do you mean when you say investing of the dividend stock? That is from Yvonne. The second one is there an automatic authorization that can be set for automatic reinvestment? I think that is also, again, a question on reinvestment, which you have addressed. Is there a ratio that you can work with that can tell if the dividend value is worth the share price? Which I think you've touched a bit on your presentation when you're comparing the case studies. And you can give maybe more elaboration on her question. The fourth one from Koi again is kindly share on taxation of dividend vis-a-vis that of capital gains. So maybe we can address that, then we'll go to Linda to give us a few insights.
I think let me start with the capital gains. Sorry, the taxation of capital gains as opposed to dividends. So in terms of tax, capital gains is exempted capital gains tax is exempted on any gains you make from shares or any listed securities on the NSE. So meaning if you invest in Safaricom and the share price goes up, that will not be taxed. You'll get your full gain. When it comes to dividends, for the Kenyan stocks, dividends they are charged 5% withholding tax, and this is actually charged before they are distributed. So that would be the only tax element on dividends, and it's basically a withholding tax. Then if we go to the other question, it was about reinvestment. What is meant by reinvestment? And I think I'll answer both questions together with the question that asked if you can have a setting that automatically reinvests your dividend. So reinvestment is basically, if we go back to the process of dividends, at the end of the year, or when a company is releasing their annual results, they will announce how much profits they made during that year, or how much loss they made during that year. So most companies, after announcing a profit, as a way to give back value to their shareholders, they would announce that they're going to pay 10 billion, let's say, for instance, to their shareholders. So meaning that amount is going to be shared across everyone, or by everyone who owns that stock. So you, as an investor who's invested in that company, then you're going to get a payment. Usually when you want to invest either through a stockbroker or an investment bank, they would ask for your details, be it mobile money or be it bank details, so that then when that company is paying out dividends, you will get the payment. I think the most common is either via check or mobile money or direct bank transfer. So then reinvestment is when you get that amount, is then you as an investor then investing that money back in the same company or in a different company. But reinvestment usually means reinvesting it back in the same company. So again, let's say for this case, Safaricom has paid out a dividend. You received 1,000 shillings from your shares of Safaricom you own. So what you should do, or ideally what's advised, is you take that 1,000 shillings and then you reinvest it back. So you buy more Safaricom shares at the current price. So, and going back to then to the next question is there a way to automatically set that? At the moment, no. And I'll explain this with the case of Hisa. So for Hisa, what we've done is for US stocks and ETFs, we have automated the process. So let's say you invest in which company pays dividends. Let's say, for instance, Microsoft, which pays dividends, and they pay their dividends quarterly. So every 3 months, you're going to receive the payment on Hisa app of dividends from Microsoft. For us, what we've done is we've automated the process, so you can actually go to the app and set reinvest my dividends, so that every time that payment gets into your wallet, we automatically buy you more shares of Microsoft. So we've made that process easier so that you as an investor, you don't have to keep thinking through the process. You just come, set, check the checkbox for reinvest my dividends, and then every time there's a payment, that money will automatically buy more shares of the specific company that you've invested in. We're still working on the same for Kenyan stocks, just because for the Kenyan market, it's a bit different. So usually for the Kenyan market, as I mentioned, the payments can be made either via check or mobile money or bank transfer. And usually that cash goes to the investor bank details. So you see, so you've invested in Safaricom, they've paid a dividend. Yes, you've invested in Safaricom through, let's say, for instance, ShareHub or Hisa, but then they'll pay the dividends directly to your mobile number. So there's no way for us to actually reinvest those dividends for you. So we are still working around how we can enable that so that then we can also have dividend reinvestment for Kenyan stocks. So for you as an investor, then you don't have to worry about or always think through what you need to do whenever you get the dividends, or thinking when the dividends will actually be paid. We automatically reinvest them for you.
Yeah, I think that's just maybe to add on what Eric has said. It's yes, it's work in progress, and I think that's also maybe like a point for our capital markets. We get to work together to be able to realize that. But I think now where we are, well, one of the things you can do as an investor is, one, to receive that money into your mobile money wallet or direct transfer into your account. Most of the brokers that are there, like here in Kenya, most of them are digital. So all you need to do is, before you think twice about the dividends you've gotten, just send through that money into your brokerage account. And then when it comes to reinvesting, you have two options: whether now to use that money to buy more of the shares that you had invested that have paid you the dividends, or maybe now to use that as to start now investing in another counter that can also provide an income stream, the way Eric had mentioned about diversifying, not having just one asset class or buying into listed companies in one sector. So you can use your dividends now to be able to do that. And I think he's mentioned this, but it's also very, very good to reiterate it, that past dividends don't guarantee future dividends. In as much as it's good for us to be able to understand the dividend payment history of the companies that are listed, it's also good to have that at the back of our mind, that it doesn't mean that if they paid 10 shillings, they'll continue paying that. But it's good as well to be able to do, because there's a sort of trend that you can be able to understand when you look at the historical data of a company.
Thank you, Linda. And I think I'll pick up from the point where she's spoken about looking at data, and point you back to the direction of ShareHub, where we have data spanning 10 years on corporate action and dividend payment on share prices. So go there and just have a look at what is happening, and you will find that it's also up to date on what is happening within the market. We have a question on infrastructure bond. What are infrastructure bonds? So I'll direct that to Linda.
Okay, I think Eric had mentioned when he was talking about diversifying, where you can have you can either invest in, you can actually, in your basket or portfolio, you can have equities, you can invest in the money market funds, unit trusts actually, so whichever money market funds, equity fund, bond fund, balanced fund. Now we even have the rates, really, estate investment trusts, and then he talked of the bonds and T-bills. And on bonds, he mentioned about either investing in the fixed bonds or infrastructure bonds. So infrastructure bonds are issued by CBK as a fiscal agent of the government. And the proceeds from the infrastructure bonds are specifically for infrastructure projects in the country. So the minimum investment is usually 100,000, and it's open for retail investors, as the fixed bonds are as well. And one very beneficial aspect of infrastructure bonds is they are tax exempt. So if the interest, the coupon that you are to receive from your infrastructure bond is 20,000, it will be the exact 20,000. There is no withholding tax that is applied on the interest that you're earning on that bond. So it's open, and it's quite popular with retailers as well. So with a minimum of 100,000, you're able to invest in it. We've had one so far with several reopenings. The government normally issues maybe 2 or 3. So we are hoping, we're looking forward to another one, either being offered or maybe what had been offered before as well, being reopened for a tap sale or such. So in brief, infrastructure bonds are bonds that are issued by government to fund infrastructure projects. One of the main features is that it's tax exempt. So the coupon, the interest that you'll be earning on the bond is not subject to tax.
Thank you, Linda. We have several questions that most of them are directed to Hisa. So these ones will be to Eric. The first question is from Moses. I signed up for Hisa last week and deposited, but investing is what in the parallels, selecting from class A assets and other asset classes. How did you guys make your first trade? Anxiety is tops. We felt that anxiety bit. So maybe you can give that a response to that, and then we'll go to the rest of the questions.
Thanks. I think I'm just trying to get the name of that investor.
That is from Moses.
Yeah, I think Moses, you've captured, I think accurately what every investor goes through the first time or when they start investing or when you're beginning, because you've maybe read, you've listened to lots of videos, you've watched videos, listened to maybe podcasts, and you say, you know what, I'm finally ready to start investing. So let's say you install Hisa or any other app that allows you to invest, and then you deposit your funds, and then you're like, okay, so we have 63 companies on the NSE, where do I start? And I think this is where, and this is specifically where ShareHub comes in. And I think, Linda, you're going to pay me for saying this, because ShareHub ideally now gives you a platform where you can start that journey without the anxiety. Because the platform, you can use virtual money to simulate the entire experience of investing and trading. So sign up on ShareHub, get virtual money, be it 1,000 or 10,000, and then now you can start looking at different stocks. The best part is that you're not going to lose actual money. So if a trade goes badly, you're like, okay, so I've bought Safaricom today, but it can actually go down next week, or I've bought this other stock, it can actually go up. So you get to learn, you get to understand the stocks, and then there's the research side, the learning side, where you get to actually now look at historical stock prices, how have they been performing over the last, period that you want to look at. You get to look at the news of the company. So by the time you then go to a live account with Hisa or any other broker, you've already gone through the experience, you've taken out the anxiety, you understand the companies a bit more, so you are more confident to then trade, because now it's not your first trade anymore. You've actually been trading and investing and playing around with things and mixing up your portfolio, adding maybe banking stocks, adding insurance companies, and looking how they perform over a week, a month, 3 months. So I think that helps, and that's usually the essence, because we want you as an investor to get a playground of sorts, where you can try out all your hypotheses, try out everything you've read or everything you've learned or everything you've watched from other people. And then when you're actually confident and you're saying, I think now I'm ready, then you can actually now dive in and say, I think I want to be a value investor, or I think I want to be a dividend investor, or I think I want to be a day trader, or I think I want to be a long-term trader who I'm going to buy Safaricom for 10 years and not look at them until after 10 years when I sell. So I think for me, that's how I'd look at it. But if you still want to trade right away or today after investing the app, I think we always encourage people to do research, do lots of research. So look at the companies that you understand first. If you're looking at Kenya, you're looking at the banks that you use. What was the reason why you signed up for that bank? Does it have competitive advantages over the next banks? How does the management look? How does the strategy for the bank look? What are they planning to do over the next 5, 10 years? And then you then look at their financials. And again, there's a webinar on just reading financial statements. How much profits did they make? All of that. And then those will guide you or sort of give you an idea to take away the anxiety or to make you much more confident before you actually then buy the share. But again, happy for Linda to sort of explain more.
Yeah, I think you've covered most of it, because that is exactly what ShareHub is here for, to help you gain the trading skills and knowledge in a safe environment, an environment that gets you confident, so that now when you start off on the real investing, you can be able to now utilize the skills that you've gained on the virtual platform that ShareHub provides, and you start on investing in the real market. So yes, thank you, Eric, for marketing us. But you can see it actually makes sense for beginner investors, for seasoned investors, to test out or any other new strategies that they want to try out before now they try them out in the real market as well. In terms of market information, there's a wealth of information on our site as well. And again, we know that is why we have such sessions, so we are able to interact with people and get to understand where they are on their investment journey, and then now see how we can be able to plug ourselves in as ShareHub, and then as well how to plug them in on other investment opportunities out there, like what Hisa is offering in the Kenyan market and in the overseas market as well.
Thank you for that. I've seen a comment on the chat on using of shorts, that we're using a lot of short forms. Sorry for that. I think it's because we've been building on to these webinars, and we will try and use the long forms for the words that we're using. And maybe I'll just also point you out to ShareHub Kenya, our YouTube page, ShareHub Kenya, where you can go through the first topic that we did, introduction to the stock market. We gave the whole wordings to, maybe if you're talking about the NSE, we said what NSE is, what CDS is, and just maybe the range of the words that you're hearing flying around. I will ask now maybe the rest of the questions. This is to Eric. With the CDSC account for NSE, will the CDSC account for NSE be the same as the account for buying overseas stock? Which brokers support the trading of international stocks in this platform? And also, if I have shares for an overseas company like Tesla and Google, if they pay dividends, how will I get them? So maybe because these three are about international stocks, you can address them as well.
Yeah. So the CDS account is basically only for stocks, for the Kenyan stocks. For buying international stocks, you don't need sort of like an equivalent of a CDS account. Once you come on Hisa, we've automated the process, so you can set up your account straight away and start investing. It should take a few minutes after your account is verified. Yes, but and again, maybe just going to the next question then, which broker supports trading of international stocks? Hisa does support investing in both US stocks and ETFs. So if you want to get started, you can check us out. Our website is www.hisa.co. And then the other question was, if I have shares for an overseas company like Google and they pay dividends, how will I get them? So on the app, we have a wallet where you deposit money, but also receive money when you sell shares or when a company pays dividends. So if a company pays dividends every month or every quarter, we're going to deposit those funds automatically into your wallet. And again, as I mentioned, you then have an option to set for the dividends to be reinvested every time that they are paid out. So you can, if you've invested in, as I mentioned, Microsoft, which pays dividends, and they pay quarterly. Every 3 months, you're going to receive your dividends, and then those can automatically be reinvested if you've actually selected that option. In terms of the fees that we pay on the app, we charge only a 1% commission for the trades that you make. So, if you buy, let's say 10 Kenya shillings, we'll only charge 1% of that. And on the app, we show all the prices for both Kenyan stocks and US stocks. So you actually get the charts and you can track the prices the way they are performing before you actually buy any of the stocks. So I hope I've answered those questions. I think back to you, guys.
I'm seeing most of the questions are also the diaspora investment. Advantage of investing in diaspora stocks. Then there's someone who's commented that I'm from Tanzania. She's just downloaded the Hisa app. Will she be able to invest? Then maybe this is a question and a comment. Thank you for the presentation. I'm following keenly. My question is, using the Hisa app, how can I follow US stock and tell how well they are paying in terms of dividend? This is from Steve. Is it wise for an investor in the global market to pick the monthly dividend over the annual dividend? So all of them are with regards to dividend, but international stock.
Okay. So advantages of investing in a different stock exchange than the Kenyan just goes back to the diversification angle we are talking about. So you've diversified sectors, you've diversified companies, you've diversified asset classes. You might also want to diversify regions. So you say, I don't want to only invest in Kenya. I want to invest across Africa, but also invest, let's say, in the US, because again, you're just spreading your risk so that in any case, if there's the stock market in Kenya is performing badly, chances are, other stock markets in other regions are not performing as badly as, or are not also performing bad. So I think the key advantages would just be around diversification, so that then you are able to spread that risk across different regions. Yes, if you're in Tanzania and you downloaded the app, you can also be able to invest through the app. So you just finish the KYC process, which is the investor profile creation. So you have to upload your national identification card or passport, and we'll verify your account, and then you can be able to invest. Then in terms of, I think the question was if it's wise to pick monthly dividends over annual yield. I think it's different because, as I mentioned, in Kenya, mostly companies pay dividends annually. We don't have any companies that pay maybe quarterly or monthly. But in the US, since we have very many listed companies, and we have one specific type of equities called the real estate investment trust, which I think Linda had mentioned initially. So mostly these are companies that are in the real estate sector. So be it managing properties or doing developments of properties. So by law, these companies are supposed to distribute most of their profits in the US, that is, back to investors. So what happens for those companies is they then opt to pay mostly monthly or quarterly dividends because they have to distribute a huge percentage, sometimes over 80% of their profits back to shareholders. So then if you're investing in such a company, then for you, it's then to look at now all the other factors, be it the yield or be it the historical performance. But usually companies that pay monthly or quarterly dividends, the dividend yield is usually very low. It's well, not per se very low. The annual dividend yield would still be, it would still compare to companies that pay annually. So for you as an investor, just to look at, does this make sense? And I think there was another question about if there's a ratio to know which dividend yield is good. For you as an investor, you're looking for the assets that give you the best returns or the most returns. So if the company is giving you 6% or 7%, and you know that you can easily put that money in a money market fund and get 10%, then that means for you personally, that's not a good investment because there's a better alternative. But then if the dividend yield for the company is, as we saw for Umeme, between 15 going all the way up to 18%, and you have an option to invest the same money in a money market fund, then of course, then that gives you an option to look at, okay, if I'm investing in Umeme only for the dividends, then you have actually a higher yield from investing in Umeme than investing in, let's say, for instance, just a normal money market fund. So I think you should always look at your investment, your portfolio, or what your options are, or what you want to invest in, and then compare those so that then you look at what the yield you're getting vis-a-vis the actual yield that you're getting from the other asset classes.
I'd like to pose the next question to Linda. And as Linda is responding, if you have a question and you would want to ask on live, please raise your hand for us to be able to select you. Linda, the question is, for instances, I'm interested on T-bills. Kindly share on how to go about that for one to bid successfully, and maybe elaborate some of the cons we probably may not be aware. This is from Yvonne.
When it comes to investing in the fixed income market, you can invest in treasury bills or treasury bonds. And I think earlier on we had mentioned that treasury bonds in terms of fixed bonds or infrastructure bonds. Treasury bills give you an opportunity to invest in the short term. So you have the option of investing either in a 91-day T-bill, a 182-day, or a 364-day. That's 3 months, 6 months, or a year. And they're quite popular now because, especially now in the Kenyan market, the rates are on an upward trend. So we are seeing most people now, that's where the focus is, the interest is. The oversubscription rate when it comes to T-bill investing is quite high. So before you start investing, you have to have an account open. And this is a different account from what you'd need when you're investing in equities, in shares. So their names are similar, so you need a CDS account to invest in shares, which now you open with a broker of your choice. Now, to invest in treasury bills, you need to first open a CSD account with Central Bank. Recently, they launched their online platform, the Do CSD, where now you're able to just go online. You don't have to go physically to Central Bank to open one. And then once you get through the process and your account is open, it's quite a seamless process. You just go in, log on to your account. You'll be able to see what is on offer. Treasury bills are issued on a weekly basis. So every week you have an opportunity to either bid for either of the three. The 3 month, the 6 month, or the 1 year T-bill. You are given a week, so you can bid up until Thursday 2 p.m. and the results come out Thursday evening and publicized on Friday. So you're able to see the trend when it comes to the rates that are there. In terms of the advantages, well, there's a bit where now the rates are going up. At least then you get there's some passive income because it's discounted, so you're able to get a discount from the T-bill as you invest. There's one of the disadvantages of investing in T-bills as well is because of their short-term nature, you're not able to trade them now in the secondary market. So that's also very important to know as an investor when it comes to T-bill investing. So in as much as it provides passive income in terms of interest income from the discounted nature, there's also the bit where if you buy a 91-day T-bill or a 6 month or a 1 year T-bill, be ready to hold it up until maturity because they are actually not tradable in the secondary market as compared to to bonds. So first step would be, yes, open the CDS, the CSD account at Central Bank. The portal is there. Once you go on the Central Bank of Kenya website, there's a link to the portal, and it's an easy process to open. And then just be able now, once the account is open, you're able to invest.
Thank you, Linda. I don't know if you have any question, anyone who would want to come on the live and ask the question. Please raise your hand. There's a question from Paul. Outside Kenya, which African company stock markets are listed in Hisa?
At the moment, we have not listed companies from other African exchanges, but it's something that we are looking at.
Thank you. Dennis has asked, is there a danger in investing in US ETFs that pay dividend every month? Seems like a good deal, but not spoken about much.
I think all investments carry risk. That's the one thing, that's the one constant we all say. And there's always pros and cons to any investment. It's about an investor understanding their risk profile and how long they want to invest for. And then now looking at the companies that fit your specific criteria. So if you're more high risk, I'd say moderate risk, not very high risk, moderate risk tolerance. That's how you see the stock market. But if you're very low risk tolerant, then that's where the bonds come in and the money market funds and things like those. So for the US stocks, I'd say, being that they're ETFs, they have less risk than direct stocks specifically, because now for the ETF, it has already invested in maybe there's an ETF that invests in 500 companies. So again, that risk has been spread already over 500 companies in different sectors, maybe in different countries and stuff like that. So you're getting less risk than you would with individual stocks. But again, even for ETFs, there's still some element of risk to it. So I think the short answer would be you still have to do your own research just to look at the specific company that you want to invest in that pays monthly dividend. And if that company or the risk profile or from your research makes sense, then you can go ahead and invest in it. But I think at the end of the day, it's understanding you yourself as an investor, what you're looking for when you're purchasing an asset. Do you want to maybe buy it today and sell tomorrow? Or do you want to buy it today and hold it for the next 5 or 10 years? I think those things are very important before you actually then decide what to invest in.
We've also received some questions that are a bit, I think, personalized when someone wants a bit of assistance. We have questions where someone is saying they're stuck, they don't know how to select stocks and investment. We are collecting all the questions, and for those that are personalized, we will respond to you individually and get in touch with you so that you can be able to be guided on what to invest, or how or maybe how to go about with your investments, and maybe downloading the Hisa app and how to begin your journey. We have come to the end of the Q&A section. I don't see any other additional questions that have come in, and I'll call upon Linda to maybe give the final bit before Eric closes.
Thank you, Paris, and I think a very big thank you to everyone, and especially Eric, for being here with us. So I think us at ShareHub is just to extend our gratitude to Eric for taking the time and coming and joining us for this webinar and sharing quite a wealth of knowledge when it comes to not just investing in the Kenyan market, but now through Hisa is the opportunity to be able to now also diversify your investment across the global market as well. So thank you very much to Eric and to the Hisa team for helping us put this webinar together. Thank you to our attendees for bearing with us this whole time, and we hope that we've been able to meet your expectations, hopefully maybe also exceed your expectations. But as Paris had said, do let us know if there's maybe one specific topic that you think would be able to cover, or maybe just something specific on the power of dividends that you felt that we can now delve deeper on, and we can be able to look into that and arrange for that as well. But thank you for joining us on this webinar. Thank you as well to the Share Hub team for putting this together. On the back end, there's a lot that goes on before the webinar comes live. So thank you for all of that. And again, it's just to mention that all this will be available on our platform and on our YouTube channel as well, Share Hub Kenya. So you can subscribe to it. We'll share the webinar. We'll share snippets here and there that we deem important to in our clients, our followers, that those specific ones that would be able to help you through your investment journey. So as we said, we're here to simplify and make investing less serious for all of us, so that we all feel like investing is a journey that all of us can take. And I hope this webinar has done just that for you, has enabled you to see the power that is there when it comes to dividend investing, and also provided a bit more insight on how to single out in the stocks that you can invest if you're looking for dividends, and how to be able to gauge which is the best, what do you start with and what, and the process and everything that you can be able to use, and how you can be able to use dividends to grow your portfolio. So thank you, everyone, and we hope to see you in our next webinar.
To you, Eric, a word from you, and also just maybe the contacts for Hisa.
Thanks, Linda, as well. And thanks to everyone for joining in. I think we've shared the WhatsApp group for Hisa. So if you'd like to start investing offshore, but also in the Kenyan stock market, looking forward to that. And I must commend the Share Hub team for the good work that you're doing. Just as you mentioned, for that investor, I think the biggest challenge is always taking the first jump. So the fact that Share Hub offers that opportunity for someone to make that jump without using actual money is very, very important for the investment journey. So looking forward to more such sessions, and we'll definitely be open to collaborating again and discussing more about how investors can start and invest. So enjoy your evening. That's it for me. Thank you.
Thank you, Eric, and thank you all for engaging us throughout this session. We've had a very engaging webinar, not just from our speaker, but also from all of you. We've received so many questions and so many comments on the topic. Kindly follow us on our social media pages so that you can be able to get the updates on the any other upcoming webinars. You can also give us feedback on which topics you would want us to speak about. You can also just watch the previous webinars and get more insight on, and also just be able to see how you can download the Share Hub app and go through the Wazito challenge and get all that wealth and knowledge on how to trade in not just the security exchange, but also just growing your portfolio at large. Thank you, everyone, and do have a lovely evening.